Good afternoon, everyone, or good evening, or good morning, depending on where you are in the world. This is an international event here at TradeStation, and we are very excited about our webinar today. Larry Williams, the legendary trader, is with us today to talk about his best trades right now. So if you want to learn how to trade or improve your trading or to follow someone with a great reputation in the markets, you've come to the right place. My name is Don Prattle. I'm the Director of Trader Development here at TradeStation, and we are very excited about the presentation. So let me just tell you a little bit, do a little housekeeping. Our presentation is for educational purposes only, and all the symbols and all the trading ideas that we discuss here are demonstration ideas only. They are not recommendations. This presentation is not an offer or a solicitation of any kind in any place where a TradeStation affiliate is not authorized to do business. Remember that active trading may not be suitable for everyone, so you need to really be sure of your suitability for any of these different strategies. Options trading does carry a high degree of risk and may not be suitable for all traders. I have posted at the top of the chat panel. You may have to scroll back to it. There's a lot of comments in the window. Two pieces of disclosure information regarding the characteristics and risks of standardized options and the other asset classes that we enable you to trade here at TradeStation. So you can click on those and they'll open in another browser. You can read them at your own convenience. Now, one more thing, and the question has come up in a number of you are concerned about the recording. Well, as I placed in the chat panel a while back, we are recording, and we do record almost all of our events here at TradeStation. You'll be able to find the presentation tomorrow in TradeStation University. I'm going to post it right here. So there is the link to the recording that will show up tomorrow in TradeStation University, our education site on the TradeStation website. We have our there's an announcement in there that my colleague Mike Burke has just posted regarding our TradeStation promotional masterclass, the TradeStation Masterclass in Plantation, Florida, the headquarters of TradeStation, next month. You may want to click on that link, take a look at that. We have a special announcement about that I'll make later regarding our presenter today, Mr. Larry Williams. Maybe he'll tell you himself. Now that I brought Larry up, I want to introduce him to you, and I want to turn things over to him so that we can get right down to it. Larry, thank you so much for spending time with us today.
Well, Don, thank you, and thank everyone at TradeStation. Just overwhelmed seeing all these names from all of our friends all over the world, and this is beyond description. I'll tell you, my heart is just unbelievable to see all these people. So that's very exciting for me. I don't have a lot of great trades right now, but I think there are some that are very potent and powerful. And not only do I want to show you those, I want to show you how I go about finding these trades today. If at any time you guys and gals have any questions, of course, feel free to jump in and ask them. TradeStation has already given their disclaimer, but I'm going to do it again just so everybody knows. Trading commodities can be really dangerous. You can lose money doing this stuff, and certainly not all of my trades are winning trades. So just keep that in mind. Some people, I go on the internet and I look at these people advertising Forex or binary options. I guess they never lose money. But in reality, people do lose money in this business. Okay, a little bit more of the disclaimer. So I want to talk about sugar. I think sugar is getting set up for a substantial move to the upside here. The red line is my forecast that I made at the first of the year. A lot of you I know purchased my 2018 forecast. Well, this is right out of the forecast. And look where we are. We're getting close. The forecast calls for the low around the end of this month, the first part of June. Well, we're not too far from the end of this month. So in terms of where we are in the forecast, we're getting close to a low in this market. And I certainly don't expect this forecast to call the market to the day or to the week. It's a general idea of, oh, we should come down this year. We have come down this year. Now we should start to go up. So I think this has got to be a market that you put on your front burner. The problem is, when I trade, I like to have more than one thing in my advantage. So I want to look at other things and see if we can get confirmation of this idea. If I look at cycles in the market, I use an interesting piece of software, Timing Solutions. I want to give them full credit. It really enables me to do a lot of cycle studies. And you can see the dominant cycles going all the way back to 2000. You see we have lows coming in here and here, and well, look where we are right now. Typically, these lows have worked. This one didn't. We had a nice up move, and then we came right back down again because we're in a bear market. So that's always a possibility. That's why I like confirmation from more than just one tool, that in fact we're in the area of a significant cyclical low, or some other setup tools that we'll see. So we see my yearly forecast report, which is based on similar years from the past, is telling us we're in the time zone. And the weekly cycles on sugar, which go all the way back to 2000, are telling us we're also in the time zone. So big question, is there more? Well, let's take a look. Here's the commitment to trader report. Now, I'm probably identified with anything in my trading career as probably the commitment to trader report. First guy to write about it way back in 1972, 73. And it's just a great tool. It continues to be a great tool after all these years. Isn't that neat? We finally have something that's really stable in the marketplace. So this is sugar going back to 2013. Again, we're looking at a weekly chart here. The red line is the commercials. Now the commercials are the users and producers of the commodity. Unlike you and I, they don't try to buy here and sell there. They're hedgers. By definition, they must be hedgers, or they're not listed as a commercial. Generally, what we see is that when they're very low in their buying activity, they're hedging, we're at market tops. Saw that over here. We saw it over here. When they're very high, as they were here and here, and over here, and especially now, we're someplace in the area of a market low. It doesn't guarantee we're right here, right now at a bull market, but it says we're in the zone, and we better wake up and start doing something. The blue line, just for point of reference, is the
Hey, Larry, Larry, one moment.
Yes.
If you wanted the folks in the chat panel are asking for you to use the pointer, if you could.
Got it. I just woke up to that. Thank you, everybody.
No problem.
I was going to do that too, and I forgot to do it. Oh, and he showed me to do that too. Okay. Hope that's better. Good, good, good. So there's a couple of interesting things about the commitment trader report. Notice when the red line gets above the blue line, we tend to see rallies in the market. We see that right down here. We saw it over here, and that's the situation we've been in now. The green line is the small speculators, the public. And they disturb me a little bit here. I would like to see the public very, very bearish on sugar to really set up a low. But there's still some things we can look at. If we look at the commercial net long position, I'm looking at a monthly chart now all the way back to 1998 or 1980, I think. We're going way back in time, right? This is the commercial net long position. It seldom gets above this red line. And when it does, we've been in the area of significant rallies in the marketplace, as you can see. So this is the most bullish, to put this into perspective, that the commercials have been going back into the 1980s. They've never had a longer long position than they have now. When was the largest short position they had? Right here. And look what happened to sugar. They also had a large short position here, and sugar declined. And this was the largest short position they had had for 10, 15 years, and the market declined. So I think that is setting up as a buying point. The question, why does sugar require special fees? Sugar, the exchange of sugar, this is the problem with the sugar exchange. They have outrageously high data cost and commission costs, and nothing the broker can do about it. So that's one of the, all markets have their detriments. That's one of the detriments of this market. So I also think there's a price floor for sugar. Again, we're going back 25, 30 years. Seldom have we gotten below this $10, $11 area. And we haven't stayed there for very long, have we? So in my own trading, I've actually began a scaled down program. I started buying sugar, and I'll buy more contracts as it goes lower. If it goes lower, I'll increase my position. If it goes lower, I'll increase my position again, because I have news for you. Sugar is not going to go to zero. People will still need sugar. there's a market for it. So we're historically very low. It can't go to zero, so I'm willing to do a scale buying program in this market, which I have begun. There's a question here, the trend is down. The trend is down. At this point, I don't care. The trend is down. I'm not a trend trader in my case. I'm accumulating here because look what the commercials have done, the most accumulation ever in the history of this contract. So this is almost a long-term play. I'm going to buy it all the way down, if you will. I'm prepared to do that. As a shorter-term trader, we'll look at things in a moment to look at things on a short-term trade. So if you want to get some timing aspect of this, here's a pretty good tool for it. The blue line is the large traders, essentially the funds. And the red line is a 6-week moving average of what the funds are doing. And the funds are very much trend players in the market anymore. It was different in the old days when the large traders were people like myself, but now it's the funds. And as you can see, when the blue line crosses this moving average, we tend to see market highs, market lows, market sell-off. So we've just gotten above the moving average. The large fund managers have just started to nibble in on this market. I've marked off the blue lines when they've done that in the past, and there's been some pretty good buy signals here along the way. So this is an example that I think sets us up for, it's just about here. The fact that these guys have started to become a buyer very intrigued me. So I think the time for this trade is real close. Question, Larry, buying July may expire. Sure, I am in the July contract now, Steve, and I'll roll over in my accumulation program into the next month. You might want to do options, or you could do a ELD, a ELF on it, but I don't do that. I'm a futures trader, so I just trade the market, and especially TradeStation, the rollover cost is almost nothing, so I don't mind doing that. Okay, that's sugar. You could use some seasonal tendencies. My risk-reward ratio, Matthew, I'm always going to try to make more than what my loss is. I'm convinced in my mind, and I could be really wrong here, I've been wrong before, that sugar can't go to zero. So I can buy it all the way down. It's not going to stay down. At some point, it will go in 10, 12, 15, 20 cent area. So the potential for the upside of this trade is pretty substantial. Okay, here we're looking at an interesting technique for sugar. The seasonal pattern is the blue line right here. Typically, sugar starts to rally about this time of the year, June, July, and we're getting into the seasonal low. So, wow, I really like that. So I know we're getting quite close now. How close are we getting? As some of you have followed my work for a while know, I do a lot of work with intermarket relationships. I think we can use the dollar index, and that's what this red line is, to forecast what will happen with the price of sugar. What the dollar index has done has been a pretty good leading indicator by about a month. In other words, these peaks in sugar were known a month in advance prior to them actually taking place, just as you can see what the pattern suggests by the dollar index now, that we should rally here. So many questions coming in here. I can't answer all. I'm going to try. Do you see any relationship between Brazilian real and sugar? Yes, there is a great relationship between the Brazilian real and sugar. That would be another intermarket relationship that you can look at. And the ETF would be cane. Thanks for typing that in if you wanted to do this in an ETF. So as I see it, my gosh, we've got this market set up, don't we? The dollar index relationship says it should go higher. The true seasonal pattern that we have unique at TradeStation says we should go higher. The commercials have been heavy buyers in the marketplace. The public hasn't been. The large traders have recently started to nibble away at this market. My annual forecast says we should rally here. And the cyclical studies also suggest we should rally here. So I don't know, guys and gals, it might not rally. That can always happen, but I think we have a high probability trade here for an up move in the sugar market. And I'll see if there's any questions here. Yes, this is being recorded. You'll be able to watch it later. If there's any questions on the sugar target, well, I think we can get back into this old area. We should run back at least into these lows back here. So you've got a pretty good size move in the market. Does that answer that for you, Steve? Can you see sugar going to, sure, if sugar could go to 5, I don't imagine it will, but if it does, I'll buy it there. In my case, since I'm pyramiding on the way down, because I'm buying below the cost of production, I don't have a stop in this trade. That's not the way you do these type of trades. This is not a trade to try to get in today and get out tomorrow. I want to accumulate a position here because some point in the future we're going to be back above the $10, $11 area. The cost of production right now is just about where we are, even in Brazil. Can you set the target high? The target's going to be, unfortunately, I can't turn my TradeStation on right now. We're looking at a target just back where we were at the first of the year. That would be our first target. Look at that. Maybe that'll help you. Okay, on cane is another sugar ETF. These ETFs, if I'm going to be in them, and my wife does a lot of ETF stuff, we always go for the one that has the largest volume. How to spot a trend change after a COT setup? Well, there's a couple ways you can spot a trend change. Let's see where we are. Okay, you could spot a trend change by just drawing a moving average coming down like this, couldn't you? That'd be really easy. You could look at sugar making a higher short-term low, which it's about ready to do in here right now. That would putting in an intermediate term low. Getting above the highest high of the last 6 or 8 days would also suggest that we have seen the market turn back to the upside. ETF for watch for sugar is cane would be the other one to watch. Okay, so that's one trade. Let's look at another trade. This is bonds. Bonds away. I think bonds are about ready to start a rally. Again, here's my forecast for bond market. The first of the year we thought it would bobble around like this, run up, come down to about now, come up into June, sell off into July, and then rally again. So that's an indication of how this market should move. It's not a guarantee, but it's a nice roadmap. That's what I do the annual forecast report for, so I can see the roadmap of kind of a leading advantage of what should happen in this market. But again, that's not enough. You know me, I like to add things together. So if we look at the cycles in the bond market and add those all together, well, look where we are right now. This is where our last low was. We had a low here, a low over here, a low over here. So this intrigues me quite a bit that we have my annual forecast report low, which is based on yearly patterns from the past. Then I'm looking at daily interaction in the market. We see we're close to a cyclical low in this market. The problem with cycles, though, guys and gals, and this is huge, just because we have a cyclical low here, we didn't rally much, did we? It doesn't forecast how big the move will be. This said we should have a big move. Well, it topped out here, and it was basically down until over here, but it was pretty choppy. So we get the little turning points from along the way. The cycles are only good, I think, to show us where these turning points are, but they don't tell us the magnitude. I think the magnitude of the move comes from the commercial position. How do you generate your forecast? I haven't revealed yet how I generate my annual forecast report. I'll listen to tell you it's a whole lot of work. Great on your trading in Robbins. Way to go. Okay, so what else can we find out about the bond market? Well, you know me, let's look at the commercials, right? Oh my gosh, look at the green line. The green line are the small speculators. This is the most bearish they've been since, way back here. And they're really bearish over here. They're incredibly bearish over here. Oh, what a great time to buy the bond market. And over here, really bearish. Look where they are now, the most bearish almost ever. You know, I love these guys because they're so wrong. Look when they were the most bullish ever, right here. Super bullish right here. Very bullish right here. So, see, I think conditions cause markets to move. I'm not a really big technician. I don't think that charts make markets move. I think it's these relationships that we look at. Tibor, I'll answer your question about that in a moment here. Every media outlet says rates are going higher. That tells me bonds will go up. Yeah, that's the small speculators, isn't it? So we've got a couple things going on. Now, if we look at the commercial position itself, that's the red line, and we're going back to 2010 now. Look what happens when it's been above the red line. And this doesn't take a rocket scientist to figure out that usually we get above the red line. In other words, the commercials have been buying that much. the market's going to rally. The blue line, Gene, represents the large traders. So that's really significant to me. The large traders, the commercials, started to buy this market, and the small specs are blown out. They think this market is a short sale, and as we see, they're typically wrong. Commercial, the bond market can be governments, it can be corporations as well, and banks, of course. So there's the public now. I've just broken out the commitment of trader data. Remember, we have those three parts: large traders, small traders, and the commercials. I break it out with our TradeStation indicators, so you can look at all of them together individually. And here's where we are. You can see what's happened when they've been this excessively bearish in the marketplace. So I want to be looking to be a buyer in here. I'm not long bonds right now, but I'm all over the bond market. I think that we're really close to a rally here. So let's look at the seasonal pattern of the market. The seasonal patterns usually around the 1st of July is when bonds have usually taken off. Not always, though. They didn't last year. Sometimes they do, sometimes they don't. Seasonals are ephemeral, to say the least. They may or they may not happen. So I want to make certain that we don't rely on just seasonal. Seasonal looks so easy on the chart. Oh, I could buy here or sell there, but in actually trading with them, that's not the case. And I'm certain a lot of you have experienced that same thing. Is percent R a stochastic useful indicator? Yes, percent R can be really helpful to an entry in the marketplace. If you tell me the market's overbought, oversold, I use it in a couple of ways that we teach, and it's very helpful. Okay, so we looked at the seasonal and bonds. Well, how about technically speaking? In fact, let's look at percent R. Percent R is now in the buy zone. This was for yesterday, by the way. Because of the delay getting everything ready, all my charts are through yesterday. Here's a seasonal pattern coming up to the upside. Now this is what I really like. The green line that you see here is my measure of accumulation. I wrote about it, I think it was Futures Magazine maybe years ago. This green line is a combination of price, open interest, and volume all together to be one master measure, if you will, of accumulation in the marketplace. And while bonds have come down back to these old lows, look at the accumulation hasn't. And that's usually a pretty good sign. Look how we were lower here than up here, but accumulation didn't. In other words, we held up here while we did go to new lows in price. So that's really bullish, I think, on a very short-term basis. So I see some accumulation has come into this market. On a short-term basis, I'm oversold in the market, and I'm close to a seasonal low. So now it's just a question of, we could use a trend line entry technique, formation of an intermediate term low. There's all sorts of stuff we can, whatever entry techniques. I'm certain you people probably have entry techniques that I don't know. They're maybe even better than the ones that I have. So there's the bonds away, I think, is right here, right now. We want to really focus in on this market. We're going to move, I think, next to another market. Yeah, so are there questions on bonds before we move away? What percent are settings? Good question. I, for short-term trading, like to use a 4-day percent R. And the bonds, I'm using the 30-year Treasury bond contract. And that's the big contract. That's where the volume is. That's where the big boys is. So that's where I want to be trading. The blue line you see is a measure of momentum, which is really helpful. The only thing we're missing right now is momentum of this market is still down, but that comes out a little bit later as the market, if it does start to move up. Okay, can you quickly show what you discussed regarding sugar? Let's just, instead of going back to the slides, yeah, commercials are heavily long, prices are very low. We're at a seasonal low, and my forecast for the year says we're at a low. Okay. Costco. So what I hope you've started to see is that I approach this from kind of a holistic view of the market. I don't just look at a chart pattern and say, oh, this should happen. You can do the same thing with individual stocks. Let me show you that. So hopefully you guys can learn a little bit today as well as just get trades. This is Costco, and this is the cycle for Costco. So currently, cycle says we should start to come down in Costco until about the 1st of July, rally up, and then a more significant low in November. So that's a cyclical forecast. So that's kind of interesting. Right now, Is there anything else that could tell us any more insight about this trade? Well, absolutely. Some of you may have seen me on the Jim Cramer Mad Money show a year ago. I showed this chart of Costco with this indicator on it. And this indicator is a relationship of the dollar index. And yes, I will talk about crude oil today. And the indicator is a projection of what should happen in Costco. So this market peak was known a year ago. This market low and this market low point and all this was known way in advance. The exact same thing I showed on Mad Money with Jim Cramer a year ago. This indicator has been kept up, and it says we should come down into a buy just before July and start to move back to the upside. What indicator overlay is it in TradeStation? This is not in TradeStation yet. This is something I've been working on the last 4 years, and I haven't released it yet because first of all, it takes so much time to figure out the relationships. It was going to drive you guys crazy. It's driving me crazy enough to do it anyway. So it's just a labor of love to produce this stuff. In this case, this is going to project out 1, 2, 3, 4, 5, 6, 7, almost 13 weeks in advance. It's not on Bloomberg. No, this one is not. Those intermarket relationships, which I use a lot. And there's, see, what I like about it, well, Costco buys a lot of stuff from overseas, right? So the dollar index is really important to their business. So the dollar gets strong or the dollar gets weak, it makes a huge difference in their business. That's what I like about these intermarket relationships. Oh, if we look at the seasonal in Costco, typically it usually rallies in October so that we see a buy point coming up. For right now, the seasonal pattern is to the downside. So I'd like to buy Costco. I think it's a great stock, but I'm not ready to buy it yet because I don't have everything clicking in here. As you see, I like to have a lot of stuff confirming it. We also do something interesting. Since I do believe so much in the trader report, since I've studied it, was the first guy to write about it back in 1973. It had not been written before. Nobody knew what it was, and now it's everybody's plaything. But I followed this so much, and I know how the commercials buy. So knowing how they buy, I'm able to develop what I call a synthetic index. If there were commercials in the stock market, this is when they would have been buying Costco here and here. This is the same old index that's been in TradeStation for a long, long time. And so what we see is they recently moved over to the sell side up in here, and they're not in the buy zone, here. If I want to be a buyer in Costco, I want to see that the commercials, my theoretical index of commercial activity, is also on the buy side. Now this is just a theoretical index. Remember, there's no commercials in the market. But since I know how commercials buy commodities, I figure, well, smart money is in the stock market too. They would probably buy in the same fashion that commercials do. If there were insiders in the stock market, would be specialists on the old days on the floor, and of course fund managers. Some of them know a lot more than others based on their performance. I hope that answers your question. Yeah, it is a synthetic index. So here's Apple, same old thing here. Here's the annual forecast for Apple. Apple should start to pull back in here a little bit, but we see the forecast for the year is basically to the upside. And we see the commercials on a daily basis have just started selling. So it's time for Apple to have a little bit of a pullback in here. We want to be a buyer, of course, right in here. It was a lot of commercial buying. And the fact we're in an uptrend and the forecast is an uptrend tells me as a trader that I want to be a buyer, not a seller, because the forecast, which could be mine or yours or cycles, whatever, suggests the market's bullish. So I'm not interested in being a heavy seller here. I'm interested in buying because I think the forecast is in an uptrend. You have record and previous on dollar index. We'll show the dollar index in a moment here. Never forget though, I can be wrong. I will be wrong. Therefore, use stops and make your entry based on trend change. What I've done is shown you some markets that are set up here. But we haven't gotten into entry techniques. I did a webinar for a TradeStation on entry techniques. You can go look at that in their archives and learn different entry techniques. But you know, just because I'm a supposed guru, the only legend I am is probably a legend in my own mind. So don't get too carried away with any of us supposed legends or gurus, because we're just as good as our last trade, just like you guys and gals. Therefore, use stops and make your entry based on just buying weakness. You want to make your entry based on the market has started to reverse and started to move in your favor. Let's look at the Australian dollar next. The Australian dollar is pretty interesting to me. The red line again is the commercials, and the commercials recently just started to move over to the red zone. They're net buyers now. This red line is they're above it if they're net buyers, below it they're net sellers. And the small spec, these little guys, right? Look where they are. They're really bearish, just like they were back here, and they were over here and over here. So we have this juxtaposition, I guess, that we're looking at, which is that we have the small speculators very negative on the Australian dollar, and the commercials have started to buy it. So it doesn't guarantee that the market's going to put in a low right here, but it certainly tells us we've got to be getting ready for this market. And now we can do a lot of work with that. We can compare the Australian dollar to other markets to see which one has been stronger, etc. Or we could look at an undervaluation measure. This is another index we have in TradeStation, something I've written about for 25 years now, I think. We can actually determine if a market is undervalued or overvalued. This is not technical. This is the valuation of the Australian dollar to the United States dollar. When it's overvalued as it was back here and up here, we tend to go down. When we're undervalued as we were in here, we tend to go up. Well, we're in an uptrend and we're undervalued now. So I think that we're close to a low point in here. It doesn't mean the US dollar will crash. We'll look at the US dollar in a little bit here. All these people calling for the US dollar to crash got killed this year. Okay, so here's more in the Australian dollar. Again, I look at the seasonal in the market. Well, now the seasonal says we should come down. Seasonal pattern is down. In fact, we should have, usually we rally from February into May, and we've declined this year. So the seasonal is not working, is it? My intermarket forecast also says we should continue going down. So look what we have here. We have some bullishness in the market and some bullishness starting to be in the market, but they're not congruent, are they? We have, it's out of harmony here. So this market's getting close maybe to a setup, but it doesn't have everything going. The markets I showed earlier had this and this and this and this and this. I used Australian dollar versus the United States dollar for valuation. It also values quite well with gold. So there's a market that might be attractive, but now let's get technical and look what I see. The seasonal pattern is sharply down here. My measure of price, open interest, and volume is coming in into new lows. So yeah, we might have a rally in here, but it's probably a rally against the trend. It's not really set up. The hardest thing for me as a trader, and I still have a problem with this after 56 years of doing this, is waiting, being patient, waiting. All this stuff is so attractive, like, oh, looks like a bicycle here today. It doesn't work out because I didn't wait for all the conditions to be there. It takes a tremendous amount of patience to be a good trader. And the other side of that coin, you have to be fast. So that's always this dichotomy. You got to be pretty fast getting in, having your stops and all that stuff, but you have to be a real slow waiter. If you like what you see here, I do this almost every week on my Larry TV commentary at reallytrade.com. So there's my commercial for you. If this is what the approach you're looking for to understand more about the markets, see these things set up in advance, go to reallytrade.com. And now back to work. Here's the Japanese yen. This is my 2018 forecast report issued at the first of the year. Oh, it should rally up and start to come down. Well, that's starting to happen here now, right? So, yeah, it's so hard to, you got to learn patience. So this excites me that maybe we have something going on here. So I want to be looking to be a buyer in the Japanese yen. Maybe, my roadmap says we should start to move to the upside. But I want confirmation because like on the Australian dollar, we had a couple things, but we didn't have all the tumblers in the lock had not clicked in place. So let's look at cycles. Oh, there's cycles. We're right at a cyclical low in the Japanese yen. The cycles have been pretty good, telling us when this market should start to decline and start to rally. The suggestion is we should rally in here, have a pullback, and rally again. The forecast indicator is Is it upside down for the chart? No, the forecast indicator is based on a lot of studies where I go back and find all years that in the past look like the last year. So let's say that in the Japanese yen that 1982 looked like 2017. Then I'd want to look at the relationship of 1983 and see what the Japanese yen did that year. And all years that have that similar pattern. Okay, well, now let's take a look at the commercials. What have the commercials been doing in the Japanese yen? And this is interesting. They were heavily long down here and in here, right? But they've been selling the market. They really just started to pick up last week. They started doing a little bit of buying. Have you discussed stock market? No, but I will discuss the stock market. That will be the last stuff that I'll be working at. The large traders, and that's the blue line, they're the momentum drivers in the marketplace. When they start to roll over, markets start to come down. When they start to roll up, markets start to rally, usually. So at this point, it's an alert. I'm intrigued by the market that the commercials, because we're at relatively high price levels, have started buying, and the small speculators have started to get out of the market. I'd like to see the small specs get out a little bit more in here, but I'm intrigued because the commercials have started buying over the last month. They've started to come back into this market, and I think that's significant, but not on its own. I want to see if we have anything else going on in this market. Well, another tool we can use is a seasonal pattern. Notice the seasonal low in this market. I've marked off every single time we've seen a seasonal low, and the majority of them have come at rallies in the marketplace. So, aha, okay, we're getting close here. So there's another trade that I think is getting set up. So let's talk a little bit about the stock market now. Again, I'm not just a hardcore believer in technical stuff. I think technical stuff can be helpful, but I don't think it's what seasonal affects the Japanese yen. A lot of things. They sell cars to America. They sell a lot of things that have a seasonal influence, and they have a lot of holidays in Japan, some very long ones, as does China, that do have an impact on their market and their production of things that they're making. So I think stocks are going to surge. Now, this was written a couple of days ago, so keep that in mind. There's no recession in sight. This, to me, is the forecast is not available anymore. We sell it, and then we don't sell it anymore because we get back to our own trading. There's no recession in sight, and this is huge, 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 huge. I have spent, as I said, 56 years doing this. I have not found any single technical indicator that is any good at calling a market top. Not a one of them. And it's not because I haven't looked. I have looked and looked and looked and looked. I have tried. I've spent millions of dollars on research, and I can't find it. I have found, though, some fundamental indicators that are marvelous at calling market tops. And I'm going to show you a couple of those in a moment. Rates are relatively low right now, relative to where they've been. So that's bullish. The yield curve is not bearish. I'll talk to you about the yield curve if you're not aware of that. Tax revenues are up. The latest tax reports show that we actually are getting more revenue coming into the Treasury. Of course we would, because we had a tax cut. Tax cuts usually do increase tax revenues. And the Fed is still boxed in here. PEs are high. That's a negative here. Fed is still in a quandary. If they increase rates a lot, it's going to hurt the economy that's just kind of staggering along. It's doing okay, not great. So they're in a box. They can't hurt the economy right now because it's going to slow it down too much. So it's kind of same old is what's going to keep happening. So with that in mind, let's look at the yield curve. The yield curve is really critical. Notice the gray lines are whenever we had recessions. Recessions mean we have stock markets, okay? And that has typically taken place when we've gotten below zero and come back, or just getting below zero is very negative in the yield curve. That's when recessions start. We've been in a negative yield curve. Look where we are now. We're not even close to a negative yield curve. Now, the slope of the curve can make a lot of difference as well, but in terms of the basic idea of the yield curve, it's saying there's no recession in sight. It's called 1, 2, 3, 4, 5, 6. the last 7 recessions, bear markets, it's done a great job of calling. You have a friend at the Fed. You know, in my old days when I was young and thought the whole world was rigged against us, I thought the Federal Reserve was just, they were just the worst guys in the world. They inflated money and all that stuff. As I'm getting older, I think that they do a lot of value. Actually, they've done a phenomenal job of not putting us through any more depressions like 1929. And they have an amazing amount of literature and some phenomenal forecasting tools. You should probably be reading the Federal Reserve notes more than you're reading technical books. So this is what they just said. The U.S. economy looks stronger now than it did 3 months ago, according to 36 forecasters. I'll show you this in a moment, surveyed by this Federal Reserve Bank of Philadelphia. The forecasters predict GDP will grow at an annual rate of 3% and 2.9% the next quarter. So, and for 2018, 19, 20, they're higher estimates for 3 months ago. So who are these 36 forecasters? Who are these guys? And do we know who, can we use these people? Oh yeah, we sure can. The Federal Reserve has these forecasters, and they're private forecasters, not government ones, that make forecasts. It's called the Anxious Index, and you've probably never heard of it at all. Yes, it is being recorded, and you'll get a notice on the webinar. So this is recessions, and this is what the Anxious Index has done. When it gets above this little line right about here, look what happens. Recession, 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 a little later, recession, 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 and recessions are bear markets. Look where we are now. We're not even close. Now, the Anxious Index is next released tomorrow. I thought that was kind of interesting, so you'll be able to watch that. You can. It's a Philadelphia Federal Reserve. You can read all about the Anxious Index. I'm certain it's an index that, except for my students, I don't know if you've ever seen before. But as you can see, it's got a phenomenal job of letting us know when we're going to be entering a recession. So there's a lot of other tools that are very good for recessions, but clearly this is one of the better ones. That's so nice. It's just there. The Federal Reserve comes out 3 or 4 times a year, and watch it. Okay, the stock market. Here's my cycle projection for the stock market. It says we should rally right here until June, then dip down, and July, August start back to the upside again. Now keep in mind, this doesn't mean we're going to crash. It just means peak here, low here. Buy point here, high up here, low here, lose momentum of the market, start momentum back up. It doesn't, markets, cycles must go like this and like this. That's the way they work, right? But markets have trend to them. So you have to adapt the cycle to the trend of the market. But as you can see right now, the cycle forecasts that I've done at least suggest that we are going to be going higher here. So markets move markets. I think there's a strong intermarket relationship. This is something I've been, that was the, is that the Dow? That was the S&Ps. Markets move markets. This is an intermarket forecast. We've been showing this on my Larry TV program for a long time. So we've known long in advance, about a 3 months lead time, this is what should be happening. Right now, this market will start to move to the upside until late June, and then we start to get a little choppy in the market. What are your cycles based on? That's a good question. As I said, I use timing solution software to help me identify the cycles, and then I try to figure out which ones have been the most dominant in the market and add them together, and I get my forecast. So my intermarket forecast technique suggests a peak in here, a low in here, and an uptrend starting to the upside. So I've consistently been bullish all through in here, not looking for a crash as so many people have. Now, if all the fundamental stuff was negative, the yield curve was negative, unemployment was negative, the anxious index was negative, it would be, I would look at it far differently. But the fundamental underpinnings of this market are still here, and as I see it, they're still quite bullish. Oh, look at this! I just love this. I wish I could predict that, Camille. I don't know what you will do in your life. The green line is price open interest volume accumulation again. This is something I wrote about again, I don't know, 10, 15 years ago now. Here it is for the stock market. Look at this. Stocks look like they've been coming down, but if we look at the accumulation coming in here, look what's going on. As of today now, this is yesterday, as of today, we are at new highs in accumulation. So all this price action in here has seen a lot of accumulation going on in the marketplace. That's really significant, I think. And another tool I look at is the advanced decline line. But we've been talking about this in my weekly market commentary. Look at this. Price can be very deceptive, but the internals, that's what this measures, because I look at what open interest is doing in the marketplace, and the formulas that's out there, you guys can go get it and do this yourself. And I look at what volumes, like on balance volume, has been doing, and then the price accumulation. So by accumulation, I mean, let me show you what I mean. It's a good example of it. Notice that prices were lower here than over here, but look at accumulation. On this decline in the market, we didn't go to new lows as price did. In other words, there weren't serious sellers over here. When we dropped a lot in here, we didn't drop over here. There wasn't serious selling. There's more selling. Here we had pretty serious selling pressures, but on the rallies we picked up more buying, and on the selling we don't get a whole lot of selling coming in. Good comment. May is usually bearish. However, if you go back and look at stock prices from 1900 until 1952, May was the most bullish time of the year. So that comes and goes. And that's again why I don't necessarily follow seasonal patterns all on their own. They're suggestive, but they're certainly not mandatory, because I want to look at the underpinnings. When green line hits red line price, no, I'm just saying, look at this. We've broken out this whole top in here. So that tells me price is going to break out of here, 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 and here as this bull market continues. Accumulation line, when it moves higher, we're under accumulation. When it dips, there's been selling pressures in the marketplace. Here's a good example. Lower low here than here, right? But not an accumulation. Suddenly, woo, the market rallies. So just look how much stronger the green line has been than the blue line, than the black line. Gold, I don't have gold covered here, but we do gold every week on Larry TV. Sorry, there's only so many markets I can follow. Gold's, we've been short gold. It's going to have a rally in here against the trend, but I don't have any major buy signals in it yet. So another tool I like to use is the advanced decline line. The advanced decline line is a number of stocks advancing each day subtracted from the number declining. I've been using this index since 1962. It's been really good. It's like one of my really old friends, and it's had some great signals in the marketplace. Notice in here when prices actually went lower from here to here, look how strong the accumulation index was, and away went the market, right? So I look for divergence in the marketplace, and we're seeing that right now. Market was lower here than here. The advanced decline line wasn't. And the advanced decline line now is also broken out prior to price breaking out. This was yesterday. We'd already broken out of this trend line, which says that, you know, this market, the internal structure, the public looks at price. Oh, look at what did the Dow do? What did the Minis do? What did the Nasdaq? What did triple Qs do? They don't look at the internal X-ray view of the market, which I think we can get from the advanced decline line and from my price open interest volume, or old Joe Granville's on balance volume would do pretty much the same thing. What day did the recent green line hit red? Again, it doesn't matter that it hit red. It's just saying that we should break out. It hit it yesterday, but that's not going to stop the market. That just shows how much stronger the market is. What does divergence indicate? Change in trend. Divergence indicates, let me make a drawing of divergence for you guys and gals. Let's see if I can do this. Oh, let's try here. So if price, oh, we better get a different color than that though, huh? Let's try this one. If price comes down like this and starts to rally, but accumulation or the advanced decline even does this, look at that. There's the divergence. Price got really weak in here, right, on that decline. But in terms of volume, price, open interest, all that stuff, or accumulation, there wasn't very much selling here compared to what you see over here in price. See that? Yes, we did go over all these lines. The market blew out everything today to the upside. A sell signal would be the market rallies like this, or rally a new high, and this happens in accumulation or the advanced decline line. Everybody looking at the chart says, wow, new high, isn't that bullish? But there's no structure underneath it to support it based on, I don't use Lowry's. I know them, have a great respect for them. Advanced decline is not a moving average. It's simply accumulation each day, the net difference between advancing and declining stocks. If you really get into it, you find that unchanged stocks are also significant. Maybe we'll do another webinar for TradeStation sometime on that. So those are divergence patterns. Hope that helps you on that a little bit. Go back to my red ball. Good. So that's it. I'm going to take questions if you'd like. I'd like to thank you for attending, and a big thanks to TradeStation. Big shout out to them. You can find our products by searching for L&L Publishing in the TradeStation App Store. Live cattle. Live cattle is a market I do a lot of forecasting for my cattle ranchers in Montana. You know, I can't cover all these markets, but cattle is going to go higher. I told my cattle guys, don't sell your animals yet. Wait later in the year. You're going to get better prices. I thought we were doing crude oil here. I apologize for that. Crude oil, I think, is in the area of a top in here. I'm not short yet, but I think we're setting up for a decline in the market.
Hey, Larry, this is Mike.
Yeah.
I just wanted to mention that to everybody that you're going to be coming to Plantation, Florida for the master class in June and host one of our lunch and learns.
Yeah, I hope we can get there in time. Yeah, I look forward to that.
We're still working on the travel arrangements, but I think Louise has a plan.
Louise wants to be there. You know, if people are still on, I have a question for people. What do you think of marijuana stocks? Is that good or bad? Can people give me a sense of that? Is that something that you people are interested in or not interested in? Interesting. And going high, yeah. And what about Bitcoin? How many of you are following Bitcoin stuff? Bitcoins, here comes Bitcoin in. Okay, well, that's great. You know, Louise and I live on a little island in St. Croix in the U.S. Virgin Islands, so we don't get out and talk to people very much. So it's kind of interesting to see what people are thinking about the markets and what things are looking at here. It gives me a little no pot Bitcoin, maybe. Maybe there's a chicken in every pot, a Bitcoin in every pot. Maybe that'll be the next campaign slogan. Okay, well, I appreciate your comments, Sarah. Thank you. Will we see oil at $100? I just think that we're in the area of what I'm looking for in the crude oil market is weakest of the complex, a break in the market that doesn't go to new highs, and then I want to look to be a short seller. Okay, well, I'd like to thank everybody again for being here, and I'm just overwhelmed to see so many of you people from all over the world that are kind enough to listen to what an old man has to say. So thank you very much. I really appreciate that. And as always, I'm going to wish you good luck and good trading, and hope to see you on Larry TV. And also, again, a thanks to Mike, and Don, and everybody at TradeStation for being so great to all of us.